Let's keep our eyes on the markets right now. We are certainly seeing a nice rebound off of the morning lows. And of course, all of this on the back of continued concerns surrounding U.S.-China trade tensions. Let's now get some more market perspective. Diana Avigdor is joining us. She's the head of trading at Barometer Capital Management. Diana, good to be able to get your perspective. My goodness, it feels quite different right now with 10 minutes to go to the closing bells versus where we started in the morning and certainly overnight in the futures market and China market, which was down over 5%. What's your take in terms of all of this?
Most definitely, Catherine, and thanks for having me. Indeed, anytime we get some news in the market, it's really important to take a look at what the positioning in the market has been, what's been priced in, how the market's been trading before, and what the exposures in the market are. So just to start off, we've been talking about for a long time about that the first quarter and up until now, the confidence in the market, despite the rally, because of the fourth quarter 18, has not been very strong. The retail investor certainly is not very invested. The marginal quantitative investor, the one that actually moves the market the most over the short term, is not overly invested. And when we have a very bullish market, we have a lot of leverage in the system. And leverage means, you know, a lot of debt to take on more and more exposure as people are more and more bullish. So the fourth quarter of 2018 has really rattled people's risk tolerance and confidence. And so they did not immediately enter the market or re-enter the market. Now, we're not talking about the vanilla players, the fundamental people, you know, and the very important, but they don't move the stocks around as quickly as we're talking about it on a daily basis. You know, a fundamental investor in Microsoft will not go in and out of it every 5%, but it can move a good stock around these marginal investors, and certainly retail is not inside the market. So there wasn't that much exposure. That's number one. Number two, we're used to Trump tweeting. A lot of people, when I came in this morning, were rolling their eyes saying, okay, this is a tactic to get more things out. And the very important thing, the fact that the delegation from China has confirmed that they are coming on Wednesday, gives us thought that this trade deal will get done.
Correct me if I'm wrong, but we're still waiting to see the composition of the China delegation. That is going to be key in terms of how serious these talks actually are.
You're absolutely right. And we'll see. We don't know. If a lack of trade deal is not good for the market, let's be honest. If a trade deal does not go through, this market is going to see a little bit of pain, especially in the overextended sectors. We will have to wait and see whether a deal will get through. We're expecting it to do so. Our conversations with people following Washington seems to point to the fact that something will come through.
Why
there is
though?
just
Diana,
no, I'll tell you why.
Yeah,
I'll tell you why. There's just a feeling that the Chinese cannot take the economic pain that it would take for a trade deal to not come through. Actually, no one can take the pain that it would bring on to the economies. Trump has prided himself as being the president of Wall Street. He's the one who lowered corporate taxes. He's the one who put out no new regulation without getting rid of another regulation. He repatriated money. He's pointed to a Fed raising rates too many times. He will not want to see this market go down a lot. And the economic fallout from a no trade deal is, you know, look, the trade deal has been priced into the market so far. Nobody's expecting it to fall through. And to point to that is also the patience. You remember that this was supposed to be till the end of March.
Right.
And what happened to that? That's just kind of went on and on and on. The market's forgiving the time that it takes as long as there is a deal.
So from a money management perspective, Diana, what do you do? And let's also frame this, not only for our advisors, our financial advisors who watch us, as well as, of course, institutions such as yourself, and then also, of course, our viewer at home. Viewers at home, they might not want to be as nimble, but maybe they do have their own trading accounts. Investment advisors have to kind of plan a little bit further out, and then institutions can be very, very nimble. So if we break it down into kind of those three buckets, what do you do and what are you seeing?
So I'm going to say, is it fair to say that you've put people or asset managers or players into long, medium, and short-term horizons, right? Over the long term, you don't have to trade the index. Asset managers do not trade the index. There is going to be sectors that work and sectors that don't work. In the case of a note trade deal, maybe you're going to want to avoid the commodity sector. We've talked about this, you and I, every once in a while. You barbell your portfolio, some income and some growth, because the market in a long-term slow growth environment, we're at 2% and we're going on 10 years now. A lot of people are talking about the Fed involvement as the reason for the increase in the cycle in terms of length of time. So you barbell, people look for yield in a low yield environment. The REITs, some of the financials, Enbridge, Trapp, Bell, Canadian banks, and U.S. banks we like as well. And on the growth side, the market seems to be also giving a premium to growth. Just look at the IPOs that have come in the last month or so, let's say, and the software and the Googles and the whole FANG. So market pays for yield and market pays for growth.
When have we seen that? It's kind of interesting.
Sorry?
When have we ever really seen that?
When?
Yeah, other than the past 10 years. So.
Rates, as rates were coming down, and back in the, in the tech bubble, you've seen quite a lot of premium being paid on potential growth.
But my point, Diana, is you don't often see them coexisting for a long time. You tend to have styles that will work and the other ones will not work over course. But these are both work. You've been doing barbell now since we've been talking for years and years now.
When was the last time you have seen the Fed this involved in everything that's going on? The Federal Reserve has always been, the banks, the central banks have not done QE for this long. We're on QE. We went to QE3 and now we try to do the quantitative tightening, and that spooked the market and some rate hikes. And so some people out there think that the central bank's involvement in all of this is here to stay. I don't think we've seen the central bank involvement or this involved ever in the past. And so I think, and when people talking about how long, they're talking, this bull market is long in the tooth, and, but you don't see no inflation, you don't see hyper growth. It's 10 years of market rallies that has been, probably most hated in history.
Yeah, we got to leave it there, Diana. Great to see you.
Thanks, Catherine. Thanks for having me.
Thanks. That's Diana Avigdor, the head of trading at Barometer Capital Management.